안녕하십니까. 오늘도 이른 아침에 이렇게 많이 나와주셔서 대단히 감사합니다. 그러면 오늘도 편의상 제가 영어로 회의를 진행하도록 하겠습니다. Good morning, ladies and gentlemen. Economic forecasting is really a hazardous business. So I recall long time ago, Paul Samuelson advised his fellow economists not to venture to do business forecasting. If she or he is forced to do it, just don't give numbers. And he or she has to give numbers without giving dates. Although the economic forecasting is difficult, at around this time of the year, not only policymakers and business planners need to look out into the next year and into the future to find numbers and dates so that you can plan ahead. This morning we are very fortunate to have a special guest speaker who will give a lot of numbers with dates, with authority, since he is associated with IMF. Gerald Schiff, who happened to be in Seoul because he is leading IMF's Korea mission, and he is currently the assistant director of department of the Asia Pacific department of IMF, and as I said, he's the chief of the Korea mission. He has been with IMF since late 1980s, and before that he used to teach the Tulane University, and also he was with U.S. Treasury briefly. He has been in Seoul many times before, so he knows Korea and Korean economy in particular better than anyone. So I just wanted to take advantage of his being in Seoul to come to this forum, share his enlightened views with us. Since many of us, including reporters there, are concerned about the current status of Korean economy, and I'm sure Mr. Schiff will tell a lot about current status of Korean economy as well as outlook of the Korean economy. With this short introduction, I would like to welcome Mr. Schiff. Please join me in welcoming.
Well, thank you all very much for inviting me and for coming at this early hour to hear what I have to say. I think Professor Samuelson's advice is probably a very good one, but unfortunately it's too late for me to change my presentation and dates and numbers. I understand that the IGE has a history of inviting some very well-known and well-respected global leaders to this kind of session, and I'm a little bit intimidated, but certainly very honored to be included in that group. And it's also quite a task to try and tell something about Korea to this audience, but I hope that maybe by putting it a bit in the regional context, that at least I can have made it somewhat worth your while to get up so early and come here. So let me just start then. What I want to talk about is basically first to say a little bit about what's happened in the region When I say the region, I'm mainly focused on emerging Asia, emerging markets in Asia, primarily because the story for industrial countries is a bit difficult, a bit different, so just to keep the focus on a more similar set of countries, I'll focus on emerging Asia. Then I want to discuss a little bit how the region has responded to the global financial turbulence that started in July with the US subprime crisis. What happened during the early days of that crisis and subsequently, and a little bit about what might still lie ahead. Then say a little bit about the outlook for the region mainly for next year and what we see as the main risks. And then finally say something about Korea within this context and the extent to which the Korea story fits into the regional story more generally. I'll start with the conclusions, just to make it simple. Asian economies have generated a lot of economic momentum in the first half of the year. And that momentum carried the region into the period where the financial turbulence began. Although there were initial fears that this might have significant impact on Asia, actually thus far, the direct impact on the Asian financial systems has been very modest. Banks and financial sector more generally have not had their balance sheets dramatically affected by the subprime crisis. And there's no real evidence that Asia's growth has slowed in a significant way since then. So we feel that the outlook for the region overall remains quite strong, but certainly the events that began in the summer have increased in a substantial way the risks of that generally good outcome. Let me start with, as I said, with recent developments in the region. Just as a broad overview, growth in the region has trended upward in the first half of 2007, and as it has been for several years now, that growth was led by India and China. Those are the two top lines in that graph, with growth in China approaching 12% and India approaching 10%. But neither of those countries show any sign of slowing, and that will have potential implications, of course, for the rest of the region, which I'll mention again a little bit later. One interesting point about the region is that there's at least some evidence of a reduced reliance on exports and some additional domestic demand-driven growth. This chart in particular is for the new industrial economies, which are the sort of tag name given to Korea, Hong Kong, Taiwan, and Singapore. And you can see the yellow bar, which is net exports, overall making a smaller contribution to growth, although still a very important one, and fixed investment and consumption tending to rise in terms of their contribution. So this is we see this as generally a very positive development, meaning that Asia in general may be becoming less reliant on exports and therefore on the global economy, although still as a region that relies very heavily on exports overall, this is perhaps just the beginning of a trend. Third quarter data for most Asian countries has not come in for all Asian countries, but the data that we have point to continued economic strength. This particular chart looks at industrial production, and one thing I want to point out is that these numbers we calculate a little bit differently than people may be used to seeing, and this is basically a moving average of a 3-month percentage change. So it's not year-on-year data, and so the numbers may not look fully familiar, but we present it this way because we feel that it kind of tells you more about momentum in any of these particular variables. It's showing something like the quarter-on-quarter change converted into annual data. And you can see that for all the categories here, for all the categories of Asian countries, industrial production is trending upward very strongly through the summer months. Consumption also looks generally good, although the story is definitely not as clear as for investment. Overall in the region, retail sales have been very strong. Consumer confidence has not been as strong, although as I'm sure most of you know, in Korea, consumer confidence has remained very, very high and even risen. The export story is one of a lull in the first and second quarters of the year. You can see that downturn in around April, pretty much across the region. That doesn't mean that growth was negative. Again, it just means that the momentum was negative. And you see a very rapid recovery since then. This recovery in exports has been largely driven by the electronics sector. Again, almost all the countries in the region have seen a sharp rebound in IT. And that's certainly true for Korea. And that's true within IT for a broad range of products. Again, you can see a pretty clear pattern across different sorts of electronics products. So electronics remains key to the region, although, for example, in Korea, certainly we've seen a strong performance by more traditional heavy industries, but IT remains a key, and therefore prospects for the IT sector are critical for the region. Because exports are strong, the region in general continues to enjoy current account surpluses. Korea is a bit of an outlier there because, as you know, the current account is approximately in balance. You can see in particular China continues to have very, very large and growing current account balance, which is sort of one side of the global imbalances that we hear so much about. And because of these current account surpluses placing appreciating pressure on Asian currencies, we still see a number of Asian countries intervening in the foreign exchange market, and we see reserves growing quite steadily. Again, this is dominated in large part by China, which as of this summer had reserves of $1.4 trillion. But the region as a whole has reserves of over $4 trillion. And again, as I'm sure many of you know, this has led a large number of Asian countries to begin to consider, to either have to implement or begin to consider so-called sovereign wealth funds, such that to be able to invest these large reserves in ways that provide the countries with higher returns and thereby lower the cost of this intervention. Korea has the KIC, which is managing $20 billion. The China Sovereign Wealth Fund will be managing 10 times that amount. So this is something that's increasingly of interest to many people, including our new leadership at the IMF, that's trying to understand better how these sovereign wealth funds will fit into the financial sector more generally, how they might behave, what sorts of effects they may have on capital flows globally. On the inflation side, there's really no sign of very dramatic inflation pressures in the region. Core inflation, which means inflation basically stripping out food and energy prices, has either remained steady or declined. Food prices have been very volatile, and especially in China, you may know that food prices have jumped up very sharply. You can see as of August up to around 18%, pushing China's inflation up to about 6% overall. We don't see that yet as a major concern because we don't feel that it's likely that these prices will affect prices more generally in China. And won't fully get into the core inflation, but it's certainly something to keep an eye on. So that's just a brief kind of synopsis of the overall macro trends in Asia. Now I wanted to say a little bit about how financial markets have behaved. 1 second, please. I mean, overall, Asian financial markets, particularly equity markets, have done very well this year. Asia has a relatively small direct exposure to the US subprime mortgage market, and more broadly to the leveraged and complex structured credit products that have had so many difficulties in recent months. However, Asian countries were adversely affected by the global sell-off that started in July and August, but to a much lesser extent than many other regions of the world. By mid-August, Asian stock markets had declined by between 10 and 20% from their peaks, and investors from outside the region had withdrawn significant amounts of money. Let me skip some. At the same time, credit spreads increased sharply, as you can see with the initial takeoff in the spreads there. What I show there are sovereign spreads, which are not particularly relevant for Korea, but are for countries in the region such as Indonesia and the Philippines, which borrow in the markets. Corporate spreads, I think, followed a similar pattern, and so in general, borrowing costs have increased. You can see there that after the initial increase, there was somewhat of a normalization, although, as we'll mention later, it's not clear if that will continue if there's a further round of financial volatility. But I think more than the downturn, what's really remarkable is how short-lived it proved, at least in the first instant. You can see this is showing the cumulative flows into emerging market equity funds for different regions. And after, with Asia being the blue line there, you can see that the dip was quite small, but the increase has been very dramatic since late summer. And in particular, since the first Federal Reserve Bank rate cut on September 12th, flows into Asia have increased very dramatically, and much more than for other emerging markets. I think that the quick recovery of flows to the region must reflect to a large extent the strong fundamentals here and the fact that overall people expect growth in Asia to be much stronger than in emerging markets more generally. It's sort of interesting question that I'm not sure I know the answer to as to why flows to emerging Asia seem to respond so much to the Fed rate cut, but it may have to do with the view that Asia still remains somewhat very, very linked to what's happening in the US, in contrast to some claims of people about delinking. It appears at least that markets, when they became more comforted about what was happening in the US because of the rate cuts, became a lot more confident about putting their money into Asia. At least that's what the simple picture seems to suggest. Along with those flows, you can see that equity markets have recovered very sharply. Emerging Asia has recovered more than emerging Europe or Latin America, which is consistent with the previous story that I just told. It's also notable that in general, the emerging markets that fell the most during the early days of this subprime crisis also recovered the most. So you see a very strong correlation between the initial drop and the subsequent pickup, which suggests that the impact on emerging markets was mainly from an overall global concern about risk rather than anything particular about those specific countries. Asia also has done better than other regions in this turmoil in terms of its foreign exchange markets. You can see that the initial decline in regional currencies was smaller, and there's been a lot less volatility in foreign exchange markets in Asia than in other emerging markets in this period since the summer. Okay, so far I've said a bit about economic developments in the first half of the year and then a bit about financial developments. So now the question is, what does this mean going forward? What can the region expect in 2008, and what are the main risks? Excuse me for a minute. This is just a summary of our views. You can see on the bottom line that the region as a whole is expected to grow by 8% this year and 7.2% next year. Both of those figures are higher than our previous round of projections in April. So we see some slowdown, but overall quite a strong economy. And I think it's worth noting that in part this reflects just the slowing global economy and lower exports from the region, but it also reflects a projection that China will slow during 2008 from, as you can see there, from 11.5% to 10%. And I think it's fair to say that this is not a projection that we have a great deal of confidence in, especially with third quarter data showing that China is continuing to grow at around 12%. So while China is trying to rein in its economy, and those policy efforts are reflected here, one risk, although maybe a positive or a negative, depending on how it plays out, is that China will continue to grow very rapidly. Overall, if you think about what the risks are relative to that central scenario that I mentioned, there are several. The most obvious is a sharper than expected slowdown in the US and the European Union. And I'll talk about each of these in turn. Second, of course, is that oil prices spike further, or even that oil prices stay at their current levels. The third is that, actually I think this third point is probably not very likely, but there's always the risk that Asian financial institutions will encounter some stress on their balance sheets. As I said, that so far Asian financial institutions have escaped these problems because of basically their exposure to these complex products that were put into question during the summer months seems to be very small, but there's some concern that, as in the US and EU, that some additional exposure could be discovered. But frankly, I probably should have put that further down on the list. A more general concern is that another round of financial turmoil globally, not so much in Asia, could again reduce capital flows to the region. And while in the summer that was short-lived, there's no guarantee that that would be the case in the future. There's also the opposite concern. I guess as economists we can be always worried about things on both sides of the ledger. So there's a concern that financial turmoil could lower flows to the region, but on the other hand, continued rapid inflows into certain countries could also cause problems, fueling credit bubbles or asset bubbles. And finally, on the upside, as I mentioned earlier, it's quite possible, or even likely, I would say, that domestic demand in the region, especially in China and India, might be much more resilient than we're expecting, and that could help support growth in the region. So first on the global growth. This picture comes from the IMF's World Economic Outlook, which is produced by our research department. And the basic point that it seeks to illustrate is that while the overall, the sort of central scenario represented by this black line shows only a modest slowing of the global economy, the risks are very much tilted to the downside. There's an asymmetry to the risks. So you can see that basically the possible outcomes are much more tilted toward lower growth than to higher growth. And actually our research department estimates that the possibility of a recession in the US is about 1 in 3. So while that's not their main baseline projection, it's certainly a non-trivial risk, and along with that, you could see slowing in much of the global economy. That slowing in the U.S. economy, if it continues and intensifies, would most likely be linked with the U.S. housing market. And I think one thing that's maybe not fully appreciated everywhere is that the U.S. housing market remains very weak and is likely to remain very weak for some time. What this chart shows is, on the left, for subprime mortgages in the U.S., how delinquency rates have developed for different vintages. So for each year, how delinquency rates develop over the months from the issuance of those mortgages. And you can see that for the 2006 group of mortgages, already after a little more than a year, delinquency rates are up around 14% there, whereas in previous years, at a similar period in time, they were significantly lower. So that's just pointing to the fact that one should expect that delinquencies in the U.S. housing market will continue to be very high for some time. And apparently, if you look at the same line for 2007, you'll see equally troubling distribution. Another fact that points to continued problems in the U.S. is that, I'm sure you've all heard about the fact that many mortgages in the U.S. are subject to resets. So early on, they have very low interest rates. This is within the subprime category mainly, or they have various sorts of grace periods, and then those reset, and households find their monthly payments increasing sharply. If you see this sort of light blue column, which represents subprime mortgages, I think that the main message there is that these resets are going to be taking place from here on through at least part of 2009 in a very major way. So that's just to say that these problems are not at all behind us, and we should expect more difficulties as these resets take place. The question then becomes, well, if the U.S. slows and the European Union slows, will this have an impact on Asia, or how much of an impact will it have? And there's been quite a lively discussion in the media in the region and out about whether Asia has delinked from the rest of the, well, first from the U.S. and second from the industrial countries more generally. I guess our view is that, well, as I mentioned at the beginning, domestic demand within the region is becoming more and more important. It's certainly premature at best to say that the region has delinked. And this chart is just one simple piece of evidence, just pointing out that the region's exposure to exports has actually grown quite substantially over the last 15 years. And of course, the U.S. has become less important as a direct trading partner, say for Korea, and for many other countries in the region, and has been replaced by China. But it's an open question still about how much of those exports to China are really destined ultimately for China, and how much is just part of the regional production process. And we think that even if, say, half of the exports going to China are really going to China as final demand, that even in that case, a sharp slowdown in the industrial countries would have a sizable impact on the region. In fact, I guess the more general point is, rather than delinking, I mean, all regions of the economy, the global economy, are becoming more closely linked. You see financial markets, asset returns more highly correlated, and you see trade flows more highly correlated. One sort of comforting fact is that in much of the region, if there's a slowdown, because inflation has been quite low and inflation expectations in the region are low, many central banks, although certainly not all, would have scope for sort of responding to a slowdown by lowering rates. So that gives the region some cushion if some of these downside risks were to emerge. The second risk that I mentioned was on the commodity price, and more specifically oil prices. I opened the Financial Times today, and the headline was two headlines. One was about $60 billion worth of write-downs of assets, which we just touched on, and the other was about $100 oil prices. So those are not two headlines that make you too sanguine, but here we can see, again, oil prices. I haven't updated this in a few days, and the way things are going, this chart gets out of date very fast, but you can already see that futures prices are pointing to some modest reduction in oil prices, but certainly there's plenty of scope for further spikes, and in particular given the obvious sort of geopolitical risks in oil-producing countries. I mean, I think it's quite notable that the region and the global economy in general has managed to cope with a long and quite sizable run-up in oil prices. And I guess certainly the IMF and I think many others would have predicted several years ago that if oil prices had reached $100, that things would look a lot worse than they are now. I guess in the region, in part, the run-up in oil prices has been offset by stronger currency, so that the domestic currency price of oil hasn't gone up as fast. And in many countries, high corporate profits have allowed businesses to absorb some of those price increases, but it's certainly questionable as to whether that could go on forever. As I mentioned, there are concerns that strong inflows into many countries in the region could be fueling credit booms, which could then go bust. We don't think that's a general problem in the region, but certainly there are some countries, and you can see in this chart, for example, Vietnam and China and India have quite strong credit growth, largely reflecting the fact that capital is flowing in. The central banks are seeking to limit appreciation of the currency, which then, given difficulties of fully sterilizing inflows, are leading to more liquid conditions in the markets. There's also a concern that in some countries these sharp inflows are somehow creating booms in asset markets, stock markets, for example. Again, we don't think this is a general problem in the region. I mean, emerging Asian equity indexes have in fact tripled since the global bull market began in 2003, but actually the run-up in Asia has been less than in other emerging markets. And price-earnings ratios don't seem grossly out of line with historical averages, but they are kind of getting on the high side for some countries, and in particular in China, where you can see that the price-earnings ratios are quite high, above 50 or 60, which can only be justified under extremely optimistic assumptions about future performance. So I'm certainly not in the business of predicting equity prices, but it's just to point out that there are concerns that some asset markets are becoming quite richly valued. There's also similar concerns on housing markets. I know that that's a subject that's very, very much in the news almost all the time here in Korea. Again, we see that as a more country-specific issue. We don't see it as a regional problem overall, as some commentators do. This shows sort of longer-term housing price growth compared to real income. You can see in many countries, housing prices have grown either in line or even slower than income growth, but there are some exceptions. The most notable ones being India, New Zealand, Australia. Many countries also have pockets of very rapidly rising prices, such as, of course, Seoul, certain neighborhoods in Seoul or in Hong Kong. But these are, in general, since they're not nationwide, probably not reflective of macroeconomic policies, but maybe more of structural policies. So I guess overall, we would say that the criticism that the strategy that Asian countries are following, which requires intervention in foreign exchange markets, yes, in some cases these are helping to inflate credit or asset markets, but we don't see that as either a problem that's extremely large at this point or very widespread, but certainly something, again, that countries will need to grapple with if these inflows continue. Okay, so that's so far that's still on the regional side. Let me touch on a little bit on Korea and how Korea actually fits into that broader story. Like the region as a whole, Korea has weathered very well the global financial crisis in the summer. I guess I shouldn't maybe call it a crisis because that has certain connotations. We haven't come up with a good alternative, so I sometimes slip into that word. I think it's kind of interesting that if you see where the Kospi was at the time of the summer downturn, and also where the dollar-won rate was, you sort of trace straight lines from where they ended, you almost back to where we are now. So it seems like this sharp dip, at least visually, doesn't seem to have had a major impact on where we've ended up. It's quite striking that we had expected that in many countries all this global financial turmoil would actually lead to a shaking of confidence either on the side of businessmen or consumers, but in Korea that quite the opposite has taken place, and we're actually in a period where people's sentiment seems very high, perhaps because equity markets are very high. Consumption in Korea has picked up very, very nicely in recent months. We see consumer sales index and also sales of top department stores, all of them on an upward trend. Again, like the region for a whole, the story in Korea on the production side is really very rapid recovery in the tech sector. You can see the blue line that IT manufacturing production had slowed quite a bit early in 2007, but now has picked up very sharply. Same on the export side. Total exports have been doing reasonably well, I would say, and you can see there that at least since early 2007, again, that's in large part reflecting gains in the IT sector. But if you look forward and think about the global market for IT, the picture is a little bit mixed. These are different indicators of sort of forward-looking indicators of demand for electronics. The U.S. book-to-bill ratio, the U.S. Purchasing Managers Index, and several others. And at best, they have a kind of mixed picture, perhaps somewhat to the downside. And so if global growth were to slow, I think the first place one might look for problems is in the IT sector, which could be a difficulty for Korea. I mean, inflation has been below the target band in Korea for a long time now, until last month, where high food prices have pushed inflation into the Bank of Korea's target band, right in the middle. And our projection is it's for inflation to stay somewhere in the mid-range of the target band. So here I'm getting into trouble because I'm putting actual numbers and dates, and people can come back and check. We're projecting growth for Korea this year of 4.8%, which would mean a significant pickup in the second half of the year, which we've already seen, and then a modest slowing to 4.6% next year. That again reflects the more difficult external environment for exports for everyone, not just for Korea. We see the current account deficit staying broadly in balance. We have projected a small deficit, but I think it's very difficult to predict that with any sort of confidence. So I would say that the picture is more of one of broad balance. I guess the most difficult part of the current account to predict is the services balance. As I was just discussing at breakfast, we had heard that this is the first year that the number of Korean visitors to Japan is outnumbering the number of Japanese visitors to Korea. So I think people are responding to changes in prices, and Koreans are increasingly traveling abroad, and that affects the balance of payments. Again, like for other countries, the U.S. slowdown can be a major risk, despite the fact that China has replaced the U.S. as the number one export destination. What this chart shows is if you look at the correlation between U.S. domestic demand growth and Korean export growth, it's very, very close, especially since 2000. So even if exports are not directly appearing to go directly to the U.S. in the data, you can see very strong correlation, which suggests that the impact of a slowdown would be sizable. Compared to other countries, though, Korea is relatively safe. Here we show exports to the U.S. and China as a percent of GDP, and you can see that for countries such as Hong Kong, Singapore, Malaysia, Taiwan, these are much more exposed than Korea. Say a few things about some issues that are not really regional in nature, but sort of specific to Korea that we think are worth thinking about or continuing to monitor in Korea. And one is that Korea has a very high level of household debt. On the left, you can see that Korea's debt as a share of assets is actually higher than in the US and Japan, as is the ratio of interest payments to disposable income. So either on a stock basis on the left or a flow basis on the right, Korean households carry quite a heavy debt burden. That, on one hand, that sort of limits how rapidly consumption can grow in this economy. Obviously, if you're heavily indebted, it limits your ability to go out and consume. It also makes consumption and therefore growth potentially more sensitive to changes in interest rates. Because when interest rates rise, for example, debt burdens can rise quite significantly. There's a particular issue in Korea that at least echoes some of the problems I mentioned in the US, although certainly the scale of the problem is very, very small here in relation to the US. But there's a sizable number of households in Korea that now have moved from the traditional 3-year bullet mortgage to longer-term amortizing mortgages. But those mortgages typically have grace periods of 2 or 3 years, and so next year and the year after, some of those households will see their payments, debt payments increasing in a substantial way, which could have an impact on the macroeconomy. We don't think that that would be very, very large, but I think it's something that needs to be kept in mind. Just say a little bit and sort of pull back from this quite short-term view I've been taking to look a little bit at a couple of longer-term challenges that we have been focusing on in recent visits here. I think it's well known among people in this room that Korea is a very rapidly aging society, both because of sharp gains in life expectancy and because of low birth rates. You can see that Korea, the old age dependency ratio, which is the population 65 or over, as a ratio to the working age population, starting right around now is going to accelerate very rapidly and quickly pass the dependency ratios in the G7 countries. And this actually, it may be the most rapidly aging society, at least in modern history, so it's really quite dramatic. This not only will have an impact on the government's role in society. This is going to present huge fiscal challenges for the Korean government in terms of increased pensions, increased health care, but also is going to challenge the ability of the country to grow rapidly, with the labor force expected to begin to decline in about a decade, I believe. So sort of thinking further ahead, we think this is probably the key challenge facing Korea. Another point, which is actually something we were discussing earlier during breakfast, is that Korea is facing challenges to its manufacturing sector because it's no longer really a low-wage society, a low-wage economy, and more and more workers are moving to the services sector. But productivity growth in services is very, very low. And actually the gap between manufacturing productivity and services productivity in Korea is I think the largest among all OECD countries. So it's really incumbent it's really critical, I would say, that service sector productivity be increased for opening of the sector to competition and liberalization, because this sector will need to drive an increasing share of Korean growth over the longer term. I just put this last slide in to give some very long-term perspective. You know, we like to talk at the fund about risks and challenges, but the point I wanted to make here is that Korea has faced much more difficult challenges in its history and has certainly succeeded in almost an unprecedented fashion. I don't need to tell most of the people in this room that, but I thought it would be interesting to just kind of dig out the archives of the first IMF staff report when Korea became a member of the fund. And at that time, Korea was actually the poorest member of the IMF. It was about 51 years ago. And this first quote is about this fund's view of Korea at the time, saying that the development plan aims to prepare Korea to maintain an acceptable standard of living when external aid ends and industry is not highly developed. So I think that really puts into very stark contrast, you know, the reality 50 years later to the reality then. So while Korea certainly faces challenges, you know, when you see the views of 50 years ago and you see what happened, you know, you can only be confident that these other challenges can also be successfully addressed. I think I'll stop here. Okay.